Hi, this is Peter Gaylord, CEO of Gaylord and Belinsky Wealth Management. This is the third presentation that I'm working on here today on the subject of bond investing, fixed income. There are a couple other videos that I've shot that I would encourage you to watch. The first talks about the basics of bond investing, and the second gives a bit of perspective on the history of the bond market over the last 30 years. Now, that leads to the subject of what should a bond investor do? We've seen recently that the Fed is expected to end a lot of the quantitative easing programs that they've had, or at least taper back on them, ending a lot of the stimulus that they've been injecting into the economy. And longer term, we can expect interest rates to increase over the next few years. The exact timing of that, of course, we can't see with a crystal ball, but we do know that interest rates are still at very low rates in historical terms. So an increase is going to occur, can be counted on occurring, and will certainly come as we hopefully see more strength in the economy in the coming years. So that sort of begs the question, what should a bond investor do? And there are a few things that would be good guidelines, and these are just general guidelines. You know, your exact situation is going to depend on your risk tolerance, your age, your need for income, the amount of time you intend to invest, and a number of other factors that you should discuss with a financial advisor. But as a general rule, there are a few things that most investors will want to do. The first is to lower the allocation that you have in fixed income. A lot of people typically in the last few decades had very big allocations to fixed income, and that worked very well because rates were consistently coming down, and that increased the value of bond portfolios. Well, now those days unfortunately have probably come to an end. And so with the expectation that interest rates will be rising in the marketplace, most investors are going to want to have a lower percentage of their total portfolio invested in fixed income. Now, in the Bond Basics video that I did recently, we talked about the subject of duration. I won't go all into that again. If you want to understand a bit about duration, please watch that video that talks about Bond Basics. But as a general rule, investors will usually want to lower the duration of their bond portfolios, because as we expect interest rates to go up, a shorter duration in your fixed income portfolio is going to insulate you a bit against rising interest rates, the interest rate risk we can expect to see. That's going to mitigate some of the losses you might otherwise occur. If you have a very long duration, 10, 20 or more years, you can expect to see a big decrease most likely in the value of your portfolio as interest rates start to go up. So as a general rule, take a look at the timing and your need for cash, but in general you probably want to be lowering the duration of your bond portfolio. And finally, consider whether there are other asset classes that you should be investing in. Typically, people have been conditioned to think of as bonds as being, a safe thing, completely risk-free, something that the quote-unquote conservative investor wants to be in. Well, some of that conventional wisdom no longer holds, because the bull market we saw over the last 30 years in fixed income has really come to an end. And so what was generally considered to be safe until quite recently no longer may be safe. And some of the other asset classes like equities or emerging markets or various other asset classes that you might invest in over the long term may, even though they experience some volatility in the short term, may be better investments or more suitable investments for the mid to long term investor. Within fixed income, there's things that you can look at in terms of alternatives to your traditional bond funds, things like unconstrained bond funds, variable rate securities, variable loans, and things along those lines. So hopefully this gives you a bit of perspective on what you can be doing. So again, for the average investor, you probably want to lower your allocation to fixed income, lower your duration, and consider other asset classes. So I hope this has been very helpful. If you need assistance with your investing, whether it's fixed income or other asset classes, or just want to learn more about investing in general, please take a look at our videos here on our YouTube channel, our tweets on Twitter. We're at Gaylord Belinsky. You can see it right here behind me on the sign. And our contact information is in the comments section of this video. So thanks very much for watching. I hope this has been helpful.